Have you ever wondered how major infrastructure projects like new highways, bridges, or advanced public facilities get funded and built, often without entirely relying on government budgets? These essential developments, which underpin modern economies, frequently involve complex financial arrangements and diverse stakeholders. The private sector invests in public-private partnership projects primarily to generate stable, long-term, and often inflation-linked returns, leveraging their expertise in project management and risk mitigation for essential infrastructure assets. These projects offer attractive investment characteristics that align with the objectives of institutional investors seeking consistent cash flows. The core reason lies in the inherent nature of infrastructure assets and the structure of these partnerships. Public-private partnerships, or PPPs, allow private entities to finance, build, operate, and sometimes maintain public infrastructure in exchange for a revenue stream, which might come from user fees, availability payments from the government, or a combination of both. This arrangement transfers various project risks, including construction, operational, and sometimes financial risk, from the public sector to the private investor, who is compensated for managing these risks. Investors are drawn to the predictable demand for essential services and the contractual frameworks that often provide a degree of revenue certainty. Private entities approach public-private partnerships by first conducting rigorous due diligence on the project's feasibility, financial projections, and risk allocation mechanisms, ensuring the contractual terms are robust. They will carefully assess the demand for the infrastructure service, the political and regulatory environment, and their own capacity to deliver the project efficiently. Once these factors are thoroughly analyzed, they can structure financing, often involving a mix of equity and debt, to fund the construction and operation phases. A key appeal for sophisticated investors, such as pension funds and infrastructure funds, is the concept of a long-term concession agreement, which can span 30 to 50 years or even longer. This extended duration provides a stable horizon for recouping initial investments and generating consistent returns. Furthermore, many public-private partnerships incorporate inflation indexation clauses, allowing the revenue streams to adjust with inflation, thereby protecting the real value of the investment over time. This makes them particularly attractive in portfolios seeking inflation hedges and predictable income. Ultimately, the private sector's involvement in public-private partnership projects is driven by the opportunity to secure reliable, long-dated financial returns from critical assets that benefit from sustained public demand and strong contractual protections. By contributing capital and specialized operational efficiency, private investors not only unlock essential public infrastructure development, but also acquire valuable assets that enhance the diversification and stability of their investment portfolios over many decades.